Hello, this is Pat O'Mara. I am the chairman and CEO of Invenium, and we are with our good friend Richard Walker from Bain, and we're talking about the reality of tokenized private markets. So this is the first of 14 webinars that we're going to do on this, and we thought we'd start out with Richard, who always does such a great job framing the issue, but not only framing the issue, but framing what are the obstacles, what are the macro drivers, what are the, what do we need to do to bring the right players together? And Richard, talk to us for a minute about what your role is at Bain. What is your practice? What have you been doing? And what are you doing specifically in this space with tokenized private market assets?
Thanks, Pat, and thanks for inviting me back. Really great to be with you. Always enjoy our conversations. Love what you're doing with Invenium. My role here at Bain & Company is to co-lead our global Web3 practice area. And, for us, it really is, blockchain, digital assets, and driving financial market adoption, of the complete tech stack to transform the financial market infrastructure. We serve large institutions, global institutions. We serve, asset holders like private equity firms, to some extent, asset allocators, wealth managers, various parties along the continuum in the private market space. So we cover the gamut from public markets to private markets, from large TradFi to private equity firms. We've had a fair bit of exposure to Web3 startups. The companies building the rails to enable the transformation through some of our private equity work. But we're a global team, very engaged team, a very busy team, as there's a ton of market activity as firms, engage to establish, their posture, their strategy, understand the microstructure for this new, market and how they can help to be a leader in the space.
Yeah, and you guys are doing great work. I really love listening to your thought leadership in this space. And from an Invenium standpoint, just to give everybody who doesn't know an introduction quickly, Invenium is from the asset to the token, right? We are a mechanism to deliver data from the edge. So we need the world's largest referenceable database in the middle, but truly a Web3 data architecture where we can credential data at the edge, turn people into their own Oracle, credential the data, build workflows to surveil the performance of the asset, kick off data-oriented workflows that can then inform all that computational work that's done, the middle office, where we're connecting all those middle office computational systems that then inform the token of the value, whether it be, whatever part of the capital stack it is on these real world assets. And Invenium really is that digital middle office solution connecting all these computational tools, both off chain and on chain. And we'll talk more about that in other webinar episodes, but this is a big part, right? You have lots of people focused on the asset to the investor, right? AML, KYC. You have people talking about creating venues for secondary trading, right? You have distribution, and Invenium is focused on that, right? How do you connect that asset to the token and have a data architecture for a distributed data environment? But there's a lot of different players we need to connect end to end for tokenized private market assets to become a reality, right? And I'd really like to talk about where are we in the infrastructure? What are you seeing in the space? What is the state of infrastructure from your standpoint? Where are we as you see it?
So I think we're well begun. Well begun is half done. But we've got quite a ways to go. Primarily because the motions here are different than the motions that have formed the industry to date. The industry to date is formed around the existence of databases and the ownership of processes within the four walls of an organization, which look very unique, proprietary to those organizations. And the only thing that leaves those semi-permeable walls are, data packets in the form from one institution, sometimes with standards, but rarely fully complete, to another institution, which then unpacks that, translates that, tries to apply it to their proprietary data set, goes back to find out, like, what did you mean by this data and the data that's missing? And so the friction that exists in the existing structure is a byproduct of the structure of the industry. And so there's quite a bit happening to rethink, well, how would we do this, if we turn the business inside out? How would we do this if we, instead of each of us having, our own database, we had access to a shared copy of that database, a shared ledger, where there's a set of standards and protocols to make sure that, what gets written, is seen by others and confirmed and validated by others. And you can immediately know, if something changed and by who it was changed. So it lowers significantly the cost of verification. A lot of that work has begun. It's well begun, and arguably not yet half done, because there's quite a ways to go. And we'll talk more about, like, where that is in the industry structure and what's happened in recent months that's informing that, because the space is constantly changing, Pat. And some things that look like a challenge actually become an enabler, which we're excited about.
Yeah, we're really seeing, as we think about what were historical checks and balances, right, where where multiple parties were taking the data and it was moving from one party to the other. You know what I mean? And we were doing that for a check and balance, right? But also for an efficiency, because one knew how to do it, the other didn't. And it was creating multiple sets of eyes. But with this distributed ledger, and you have a trusted ledger that everybody's looking at, you don't need some of that function of the checks and balances. You need different checks and balances, right? But not the ones that existed where you're moving data from one organization to another, and then they have to validate that previous data and then pass it on and validate that data. And people are redoing the work of the previous entity just to check to make sure that it's done, because these processes, which we would call microprocesses, right? If you think about it, a lot of people would talk about it a gig function, right? In a gig economy where one entity is calling on 6 people to do it. But from a technology perspective, we think of these as microprocesses that people can understand and trust the data going into the process, understand the process and the data coming out, and they can agree with that oracle or that process or not, and then they can get an alternative one if they do it. But the next person, if they accept it as an oracle of being that function and computation is correct, they don't need to redo it. They don't need to recheck it. You know what I mean? Because they're that process, that proof of process, we can deliver through a series of zero knowledge proofs and other such mechanisms where literally these microservices we can fit together. Now, one of the ways that speeds up dramatically is the time-based function, where you go and you take it from this entity and you do it to this entity, you move it to a different entity, and they have to take over a function. There is a human function where literally it then goes into somebody else's work queue. They weren't just waiting for that handoff, and that time lapse really compounds. But not only that, the third person who then has to reconcile what the first one did, that the second intermediary checked as well. Each additional step makes it logarithmically more difficult instead of arithmetically more difficult, because they can't trust and see the process. And so what we're doing is we're massively simplifying these processes, right, in what that data reconciliation is. And that final person, even though they can see everybody's work, that data reconciliation from 3 days ago on a trade for a complex instrument, man, that is a challenge. And people pay a lot of money to third parties to do it, and that's going to be completely automated. But for that automation to happen, we need to not only conceive of all those steps as microprocesses, train people to trust the proof of process, but believe in it. And these middle functions may not go away, just some of the middlemen, or how that middleman himself functions. It might be more of an oracle and less of a 10-finger automation, because there's a whole lot, particularly in the private markets, where you have a first-year Cornell grad doing 10-finger automation with Excel from a paper document. You know what I mean? And this mechanism of how do we ingest data, process it through, deliver a zero knowledge proof so it can be passed on to the next entity or next process, microprocess that might exist in a smart contract. It might exist in a Deloitte Cascade or a Cascada for a waterfall or a valuation engine going into Argus Upload or whatever it might be, this middle office function that we're doing. Many of those are going to be automated. Some are going to need the subject matter expert and real intelligence applied to artificial intelligence and automation, right? That are going to need that expert guidance along the way. And we've got to put all these things together. And I think as these microservices coming together, it really is like a gig function economy vision of the services being delivered. And what are the roles where we need expertise? What are the roles where we need custody? What are the roles where we need relationships? And what are the roles in which we need Oracle so we can tell the truth of the data, right? And how do we bring these various functions together, and we're bringing that end to end. And I would say I'm seeing an enormous number of people at the very largest financial institutions who are working with us leaning in hard to the data problems associated with this, whereas before they were just on how are we going to distribute this, or how are we going to do AML KYC, or kind of the first order problems, but not the second order problems. Richard, do you see that in your world? Are you seeing these second order, third order questions being tackled at scale?
Pat, great framing. I like the way you laid that out. What I was thinking about as you were, describing that as work we were doing in, 2016 to solve some of the third order, challenges. Because those, the potential of the base technology to transform some of the fundamental underlying functions of the rigid and arguably fragile financial market infrastructure aren't new. They've been there. And we've been doing work with organizations around cap table servicing, asset ownership tracking and verification, enabling various functions and capabilities, such as reducing settlement time, risk, verification of funds, and things like that. That's that has been there, but it's been interesting, and there's marginal improvement, but without a broader ecosystem and without broader engagement and without an asset and a market that would open up that would be net new, there hasn't been the level of energy required to develop the infrastructure for the each of those first, second, and third order benefits to be realized.
Keep going. I'm sorry, buddy.
I would say and I've talked about this before, but there's a bit more to the story now that crypto really served to monetize the build out of a lot of infrastructure, and TradFi firms have watched it and say, gosh, that's interesting. Wouldn't it be great if, but we never could, the asset's so different. And, it developed, over, arguably, over 7 years. It was there earlier, but, really started to hit scale 2016 and on. And it built the infrastructure. And, given events of last year, our view had been that, post crypto, right? Crypto's gone as far as it can. Thank you, useful, right? Will continue to exist in some form, but wholly insufficient to monetize the next level of build out that will, provide the facilities for, real world assets, public market assets, private assets. And so, our view going into this year was, the next wave is really the tokenization of private assets, because you get new functionality from that. The market is huge, and that will, provide the catalyst to get each of those benefits you described, Pat, because it's, a benefit here and a benefit there, and within the four walls, we can transform this process. Interesting, but without a holistic kind of end game, organizations they didn't have the energy to get around that. Now, the interesting thing that's happened during the liquidity crunch is that, crypto may, come back into play for liquidity solutions and further extend, the monetization and build out of capabilities needed in institutional finance. And I'd be interested to hear your thoughts on that and what you might be seeing for, the liquidity solution opportunity, and maybe even a convergence of some of the, crypto assets and some of the tokenized real world assets.
Yeah. There's a question that was just asked by a LinkedIn user, right? Where is the improvement from tokenization and processes being sold an additional layer? When does it remove layers, right? One of these issues. A great question, and let's hit that, right? And I want to hit on 2 or 3 things that you said, right? I'm going to go back to the comments you made in January of this year about where is crypto going to return? Where is it going to bring that back? Where are we going to see the resurgence and how it's going to come back and be a player? Because it is a bit player when you compare it to global economy, when you compare it to tokenization of private market assets from a scale perspective, it is tiny. And the big firms all see that, right? And this process efficiency, people see that and they say, okay, I can get 10% improvement or 15% improvement or 40% improvement, which may or may not move the ball, move the needle for them, right? From off to on, right? Where they go, okay, gotcha. That was a fine POC, but thank you. Where we're seeing some real issues is when you think about the resiliency, right? Because this is a centralized model where you're making a ton of money in tech that works today. Now works, but shaky. And we know that, right? And, a big company that we work right now, they have a software program that they use as a general ledger. They have 10 instances of it running in there because they're becoming unstable. And rather than they can't grow it. So what they're doing is they're walling that off, creating redundancies around that. And any new clients now go into this. So they literally have of a software that's supposed to be an enterprise software, 10 versions of it running in what is a centralized form. And you just go, that's not great. But their ability to move to the next generation of that is limited, right? And this is why you have Cobalt programming being offered again, because people need to maintain systems that are literally as old as you and I, Richard, right? I mean, that need to be maintained. And a risk mitigation function is this resiliency of decentralization that, if, kind of an arrayed server, right? Where literally you're looking at this, where this mechanism, if one goes down, it's okay, we're fine. But what we have is disaster recovery, not resiliency from total decentralization and the ability to handle varying load capacity. And this is where decentralization of these functions, we're going to see some real great movement forward. So I want to, and I'm going to just go off track real quick. And I've mentioned this before, right? Elon Musk, everybody should watch his interview with Space Force, the head of Space Force, where he talked about coming in and they asked him to help where they were tracking with the missile guidance systems, and they were tracking. And they said, what is your efficacy? And they said, we're at 99.3% efficacy. And he was like, I don't want to play in that. And the reason is, how do you make 99.3 better? And one of the reasons is money was no object. They didn't care. They just needed to hit the missile that was incoming. Does that make sense? And what he said is, I had to get out of that system, come up with another mechanism where I could deliver space flight instead of at $19 million per, I think it was $19 million an ounce. And then it went to 1.9 million, and then 190,000. And now we're at $19,000 an ounce is our cost to deliver, something into space, and it's operational. That only happened when he went completely outside and got another benefit, right? And then that completely transformed the legacy system. That's what we're seeing now. And that gets to your crypto, because what we're seeing is, as the existing system is locking up and the banks have had a run, particularly small and regional banks are having a run. There are all sorts of parts of the market on their deposits, right? And it's sitting in money market fund, and it's underutilized, and people aren't sure they want to get back in. Parts of the market are frozen up. And this is where we're seeing real opportunity. And CoinDesk this morning had an article, right, where stable coins are a primary driver of treasuries and tokenized treasuries, right? They can't get enough of it. And we are seeing in these large liquidity pools a desire for more real assets. They want the type of assets that are created by communities, community banks. They don't want a CDO and a CLO. They want to be buying these individual assets, putting together an algorithm that can be buying these assets that can be part of the store of value where people have the utility to use that stable coin on their phone. And that is the opening of the door of mass distribution and global distribution of financial products, ease of use that the younger investor has. And from my standpoint, when we look at KKR and Apollo and BlackRock and Blackstone, particularly, and BlackRock might be not like the others, you know what I mean? But those three, they've all set goals for growth that are epic, 100%. 400% growth, and they all believe that the way they're going to get there is global distribution. A number of them to the mass affluent. How do they reach the mass affluent? You can build a huge sales force. Blackstone has been investing in that for a while, and they're getting there. Do you know what I mean? But the question is, what are we going to do to get these large funds? And I think the $1 million funds is a separate question that we'll deal with in a minute. But when you have these large alternatives players that are saying, I want to take my alts market, I want to get more liquidity in it on both a secondary basis and primary distribution, that has to be on someone's phone. And if somebody can't buy it on their phone in the Asia Pacific region, they're probably not going to buy it. You know what I mean? And what we need to do is say, we are now understanding that crypto may in fact be that bridge, right? And it's going to be the bridge because the stable coins want to be the buyers of these private market assets, but they want to hold them in a tokenized form. And they're saying, how can I find that bridge where I can be a form of syndication of these origination of loans from all over the world, right? And there's a very famous example with Huntington. I don't know if you want to talk about that, right? But and that led to their purchase, where they got liquidity from MakerDAO. I don't know if you want to talk about that as a use case.
It's interesting, right? So Huntington, did do a pilot project, right? Right. So they did something with MakerDAO, and then they were purchased. It was really an innovation premium, on a community bank, and it's indicative of the kind of Web3 experiments and exploration of DeFi markets that TradFi firms are doing. I'd like to talk about the growth in AUM in private assets, because I started to allude to doing work 7 years ago in 2016 around the efficiency of DLT and blockchain to replace some of the capabilities of existing infrastructure. It was insufficient. You need another driver, a new revenue opportunity, right? A net new play. Because we may lament responsiveness, rigidity, fragility of the existing market structure, but it's working, Pat.
Yes,
it's a pretty big market, right? The global equities market's $100 trillion globally, and it's pretty efficient. So trying to say that that's broken and to bring these capabilities to remake that one change at a time is likely a fool's errand. But when we look at the private market, and we do know this, that many wealthy investors want to increase their holdings of private assets, private alternative assets, and that I'm just looking at a chart. Investors holding 70 trillion in wealth are the biggest underserved candidates for private alternative assets. When we have a report coming out very shortly, a brief that will be out on this, titled, Time to Reach New Retail Investors with Private Asset Investments. It's a report that we've been sharing since March with clients, but it will be a Bain brief. Net, there is, and I've mentioned this previously, there's 8 trillion to 12 trillion in assets under management positioned with individual investors that want exposure to private investments. And the current mechanism, hundreds of pages of LP or GP documentation, the large entry size 1, 5, 25 million, the high level of illiquidity, the long hold periods, that just doesn't work to grow AUM. The firms you mentioned have all articulated a desire to increase their AUM by trillions. This architecture we're talking about, tokenization of private investments, is the way to make this happen. And it's because of that latent demand by private investors have exposure to these assets, and the demand on the private equity or private investment side to grow their AUM, that those things will meet in the middle, and that's how we'll monetize this build, Pat. It's not necessarily through liquidity plays there, right? Because you need a settlement currency for this to be truly efficient. But the first wave of this likely, may not include that kind of settlement currency. It may still use a traditional settlement mechanism, but the ability to purchase a tokenized fund unit at a lower price point. 2 weeks ago, there are several funds who are active in this space. One they just launched their third fund in this space. And that fund previously had a $2 million minimum investment requirement. Under this new model, it's a $10,000 minimum investment requirement. The regulatory environment still dictates that you're a accredited investor, qualified participant. So, to get access to true retail, we talk about, in Asia, maybe that's possible on your phone. In the U.S., there still needs to be some collaboration. And if we look at the ability to provide the investor protection around exposure to assets like this to enable diversification and growth of wealth, that could really lead to a breakthrough in this space. Even without that, the fact that globally, wealth, half of wealth is held by institutions, half is held by individuals, but institutions hold 85% of private investments. So if that could go to 50-50, that will move the needle, so to speak.
Dramatically. And we're talking about mass affluent first, right? As the first player. Retail, I view as down the road. But I want to talk about there's a number of questions that were in here that I want to hit, and we're gonna go through the questions one at a time as we have this conversation. So keep those coming because they're excellent, right? But part of this is liquidity just based on a secondary market? And I think that there's a couple different pieces. Number one is better data and price discovery that unlocks value as form of borrowing, pledging, better accounting treatment, better treatment from a capital reserve standpoint. That is a huge benefit, right? So price discovery, auditability, observability of data elements changes the liquidity and the balance sheet treatment for institutional players and the access to borrowing. Huge difference. Right now we are feeding data with quarterly third-party marks, monthly trend analysis for large real estate assets for a top 5 Japanese bank, directly feeding their risk book. This has transformed their risk book and how they're doing it, and they are adding assets real time because it changes how they mark that asset from a risk perspective. So that's impact number one. Impact number two is how you can pledge that and how you can access capital is huge. Primary distribution and opening the door for mass distribution and secondary markets, those are all coming, but we're building templates that you can drive trains through. And not that we can do a trade, but how can we do a trade at scale, at volume, that we can deliver liquidity pools to other parts of the market that are illiquid right now. And that happens all the time. We know it by geography, by country, by market segment. for whatever reasons, different people lock up, and then other parts of the globe have that. And only the biggest of the big global allocators have the ability to move with speed and provide liquidity in order to get those good values. Do you know what I mean? Because people will take a discount if they can get liquidity on a real-time basis, right? And if we can do away with not only the data asymmetry, but the access point, we're going to start to see a more efficient marketplace connecting up and growing. And so it is connecting liquidity. And right now, there's some liquidity pools in crypto, and CoinDesk wrote about this morning, particularly with stable funds, and they are looking, how do I plug into this? Now, for them to plug into this, they need data that they can use. And so the question that one of the folks asked from LinkedIn was, how are we getting that data in, right? And Invenium, about 2.5 years ago, we wanted to buy something off the shelf. We looked at Canoe, we looked at a dozen different systems to ingest data, but everybody knows in alts, all the data is unstructured. Everything is different, right? And so what we started doing was building it, we call it AI Assist. We began where anybody can build a template, and we began just using AWS's tool, primarily Textract, right? But then now we have an API directly to GPT-4. We were demoing this yesterday to the C-suite of a $400 billion assets firm, where literally GPT-4 was pulling data from documents, legal documents, limited partnerships, taking that in. But it's not just extracting the data. It's then a pointer back to where in the document it is, anchoring it in the payload of a block, and you can prove, through a zero-knowledge proof from all time forward, this was the state of the data at this moment that you relied upon. So there's changes in the future. You can see the state of data changing, and you can recreate calculations. You can add side letters as you restructure the fund. Everything is built there. And so we'll have another third model there. But Invenium didn't get into this business because we're AI guys. We got into this business because we needed the tool in order to ingest data so that we can anchor it and begin pushing through. And 10-finger automation and a first-year Cornell grad is not a good middleware. Do you know what I mean? But that is, in fact, how.
But it's all we got. It's all we got, Pat.
Right. And so, and by the way, nothing against Cornell grads, and I'm picking that out of the blue, right? But it could be anywhere, right? But the point is, we can now ingest this data, automate it, and Invenium, we're spinning that company out because we don't need to own it, right? And we're getting partners to come in who are going to co-own it with us, driving it into other verticals where it's a template creator on top of multiple AI engines. And how do you ingest data fast? And then how do you credential that data so that somebody can trust it in the future so they don't have to redo the data, right? And this is a mechanism where you apply trust to a compute function, right? That's all the blockchain is. How do you create trust through either zero knowledge or making it public, zero knowledge proofs, where we're doing this. So this is all the beginning of the journey. Then it's going to go through a dozen compute functions to get to the point where you have a token that can sit on my phone and it represents my ownership in an ETF of, or a 40 Act fund or an LP interest that I can take my paycheck and I can dump into that every single month. I connect that up to a MasterCard, and when I want to buy my Starbucks, or Dunkin', depending on who you are, you put it on the POS device, and literally you've paid for your Starbucks, and it settles either daily, weekly, or monthly using a merchant account intermediate function. And literally how you store value has changed. You're not depositing it into a bank anymore. Why would you use a bank, right? Except as a custodian, and where there's lending functions that are going to be against it, and all this, and as originator of loans, as an underwriter of credit, suddenly this store of value has changed. And this is where large real estate owners are saying, I want people to have their paychecks rolling into these portfolios, and I'm fine if they're going to get in and out. And by the way, big global trading firms are saying, I'm going to be a market maker, not in IBM, but in real estate, in types of real estate. And if there's data elements in there that I can understand a homogenous class like light industrial or multifamily Europe, multifamily US, or even by region, and they can make markets in those things and have bid and asks, this whole game changes, brother. And this is where you have entire business units being stood up in Fortune 20 companies that are now saying, I'm going to make markets in parts of the global market because the data is there, that once I make markets, it's going to change how these things trade. And so the individual developer in Tulsa, if he can get his data online for them to be a buyer, he literally can have Fortune, let's call it 100 companies who are willing to make a market in his 350 unit apartment complex in Tulsa. Like, that's crazy, brother. Like that connectivity is the transformation. I'm sorry,
Yeah, and Pat, a compelling vision, very, very compelling, and believe that we're on a path, for that end game. But delivering private alternative investments at scale is going to require new infrastructure and workflows across 5 areas: across fund management and issuance, across distribution and wholesale, across liquidity, across post-trade services, and then across all 4 of those in asset administration and wealth. Because there are new capabilities you describe, right? The fund creation, tokenization in fund management, in distribution and wholesale, the customer acquisition, the servicing and lending there to create the liquidity facility. In liquidity market making against these new, tokenized private alternative investments. There's a lot to do. And, arguably in every one of those 5 areas against, new capabilities for workflow and around, significant change of capabilities, there are things happening. When you zoom out and you look at, right, the experiments, somebody might see something happening, on, fund management and go, oh, that's interesting. But then you go, oh, well, there's something happening here and here and here and here. And all of a sudden there's a supernova of capabilities that hit maturity. And then you have an exponential need towards scale. We believe there's an opportunity for, for firms, and in particular for, the work that we're doing, for the largest wealth and asset management firms to seize a first mover advantage by establishing strong brand in this space with a broad base of investors and providing access to these private investments. Smaller firms can still thrive as fast followers, if they make smart choices around, how they play. But this is going to be driven by the large firms, and there's going to continue to be a role for select intermediaries. In this model, this is not a DeFi, self-sovereign, point-to-point. We don't need banking and bank infrastructure. We still need credit formation. We still need.
There's going to be people who need to stretch your brain.
And that's all like a primordial ooze right now developing, right? And the level of vibration is increasing.
I'm gonna say that we're beyond primordial ooze, and the reason I would say that is we're starting to see some of the early adopters, and I'm going to call them out by name, right? Coinbase is doing great work. Citi's doing great work. U.S. Bank is doing great work. Franklin Templeton, I think that, and the leadership at the very highest level from Jenny is fantastic for the entire industry.
Can you look at any one of those examples and see the vision for where? So like the ooze, like
no, but we're starting to see.
But
we're starting to see
the terraforming, right, and the creating this new structure, right, will come out of those things. So,
So let's take a couple of these where they are creating something, and they're now connecting with another, and within that, we're starting to see liquidity move back and forth at scale, and we're beginning to see several of our clients through Invenium plugging into each other, into what those different pieces are, right? The fund administrator, the wealth management, the distribution, the structuring, the accounting, the auditing function. And somebody asked a question, are you saying this to bypass regulation? Every single player we're dealing with is dealing only with regulated securities. So
Totally.
we're not interested in anybody who's doing something who says, oh, regulation doesn't apply to me because I'm not using a SQL database, right? That's silly, right? So what we're doing is, so everything we're doing is regulated from 100% standpoint, but I'm starting to see from where I stand, and we're going to start seeing more like we saw with Huntington. And I stressed the D there just to really make sure that you were happy. But this, we're going to see more like that, where we're going to see crypto and stablecoin and significant liquidity seeking interface. And we're starting to see that. And I want to tell you, and I don't mean to go overboard on this. Franklin Templeton, the reason I'm touting them so much is they're not a client of ours, right? So I'm not talking about somebody who's a client. What they're doing away from us, unfortunately, is so cool, right? And we're seeing them start to deliver. And when we see these little experiments of what's going on, and innovators, SDAX, ADDX, Archax, SDAX and ADDX in Singapore, where there's a lot of motion in Gift City in India, a lot of motion for tokenization, right? So 5 big tokenization projects sponsored by the government, dollar denominated, moving forward. These are immense. And you look at this and you just say, these are going to sit on people's phones. They're going to buy and sell them. They're going to be buying at 10, 20, $50,000, $100,000 lots. But not only that, they're going to be able to borrow against them. And there are going to be secondary exchanges against them, and they're going to have liquidity, and they're going to have third-party marks. And all of a sudden, this level of transparency that is being called for by the regulators, in the APRA in Australia for the superannuation funds. The superannuation funds have called for 50% exposure to alternatives in the superannuation funds. That's insane. And they're saying that the condition precedent is third-party marks on the alternatives. Once we start having third-party marks and price discovery at scale, those superannuation funds are going to say, I'm a buyer. And they're not just a buyer of Australian privates. It's going to be global privates. That is one of the biggest pots of money out there, right? And then you go out and you start to see all these other players. And I do believe, and Richard, I'm getting on my stump, and I'm just talking. I apologize. But are there any of these other questions that you want to hit? And we'll answer any questions that are out there. So please come up with those questions. Richard, were there any of these questions that you wanted to hit?
You're the moderator here, Pat. You call it. If there's any that you want to
sure.
cover, I'm happy to do it.
So we had 2 people, right? Where is the improvement in tokenization and its processes? I would say we see massive reconciliation function. We see the ability to move data at scale where it can be trusted by multiple parties and it can be delivered through processes. And one of our clients alone at our conference stood up in front of everybody and said they are going to save 30,000 man hours in 2023 using our tool because they can process data and they can trust data across multiple units. Those are kind of some of the processes that then open the door for the distribution, big vision, right? But Richard, it's like you said at the beginning, those efficiencies won't do it. There's got to be that final piece that is the big vision of the connectivity and liquidity.
Yeah, that's right. And I would say the cost of verification is very, very significant for financial markets operations, and it adds to cost, to risk, to cycle time, to experience, and removing that is going to provide a major lift for assets of all types, public and private. Private in the most immediate time horizon. And our view, Pat, I know that you cited some great examples of things that are happening now. We believe that for private investments and the growth of individual investors, that it's going to continue to develop, and we will see this, I mentioned like a supernova earlier, set of capabilities in likely 5-year kind of time frame. It's going to continue to develop. There's going to be benefits. We're going to see growth in this space. If you look at the 500 million, it was on CoinDesk earlier around assets flowing into these tokenized money market fund units to gain exposure to treasuries. It's super efficient and attractive. I was at the gym this morning. This is CNBC, and they were talking about the 1-month T-bills, providing over 6 or up to 7% return, and it's like, boom, I want some of that, right? And that mechanism provides the ability to do that on your phone from the gym right now. One thing that you do need to note about private investments though is that there's some concern about the amount of volatility in private investments. We don't expect there to be the same kind of trading activity and volatility of moving in and out of assets, even when private assets are tokenized, that we see in public markets, because of the kind of returns they produce over long periods of time. That it will be a more stable base within a diversified portfolio.
We agree too, and everything we're working with and structuring right now, we're talking about quarterly trading for 4 hours. Do you know what I mean? We're talking about monthly trading for 2 hours, where there's an interval fund that's going to have the ability to redeem the interval amount. And if they ever do get over, there's a run on that, and they have to max out and stop redemptions, where they will automatically create open trading 2 weeks later on an exchange, right? So these trigger events, and we're working through these real time right now with a number of players, where how are we going to build these mechanisms? How are you going to deliver the data so that a secondary mark, if redemptions, because people don't believe the mark set by the GP, so they're going to say, I'll take that price all day long, and they run, then they flood for their redemptions in an interval fund, right? This is BREIT. And all of a sudden they say, I want that. Okay, once that gets maxed out, and we're going to open up trading, on a quarterly basis, right? And we're going to have an open market trading for half a day. What is the data they need at the asset level, where they can set their own bid or their own ask, or third parties like a Cushman & Wakefield, one of our investors, who can set that on the asset and say, this is the third party mark on the component parts. So you can do your own math as to what the real price is that you're willing to bid on it, right? Mm-hmm. And or that you're willing to sell out at a discount for. So I think these are elements, and we're going to see more things also around Reg A. I think ICE and New York Stock Exchange, what they're doing around tokenization and Reg A, wow, that's going to be a big piece once that starts kind of offloading. But they're putting a ton of time, a ton of energy, and a ton of expertise behind that.
Yeah, I want to address one question, and then I'll offer one final referral on this question of how would tokenization support the distribution of private market assets when the regulations prevent them from being distributed to many individual investors. You don't need to go down to the retail investors to tap access to $8 to $12 trillion in individual money. That $8 to $12 trillion exists within that investment class, which is permitted by the regulatory structure. So that the targeted growth by private equity funds and other asset holders and asset issuers is fully sufficient to make this a worthwhile endeavor to move the needle. Over time, as the infrastructure gets developed, the transparency, the trust, the other market facilities, then the regulators need to revisit that and think about whether they're keeping an investor class from having access to a high performing asset, which could lift many investors. Now there's just one last comment on this. There's we have a podcast called Dry Powder, which Hugh MacArthur does, and he did in mid-May an interview with Jim Strang, formerly of Hamilton Lane, now at HG Capital Trust, talking about tokenization from the position of a somebody who runs a fund who has exposure to this and has a view on what would need to change. And he cites things like, right now funds do valuation on an annual basis. At a minimum, they need to do that monthly. And some of the other changes that are required, and that are being worked on, by funds. So it's not just, a consultant and a platform provider, but, those running funds see this as well. And, he cites, and, we'll put it in show notes, that, every fund is working to figure out what is their posture, because every fund recognizes the significance of this development and the opportunity to be a leader.
And let's take it one step further, right? There's a whole bunch of other fund classes and types, right? Private REITs. How can price discovery, better data allow them to access capital, right? I mean, when you're talking about evergreen funds, when you're talking about the new SETI regulations for AIF funds in India, these are all opening the door. Ken McGuire has a comment about a QP, where a $10 million, a guy who's got a $5 million net worth, that guy who's making the $5 million, who's got the $5 million of investable assets, him making a series of $10,000 bets is significantly better than him paying for a fund of 2 and 20, right? Where he can actually go in and say, I'm going to create my own portfolio of these, where I'm building that up. Because instead, what he's doing is giving it to Morgan Stanley, and he's putting $500,000 in a fund of funds, who's putting him in 100 different funds. But literally, that fund of funds market, it's going to change. You know what I mean? And the fund of funds market is going to be more retail oriented, right? And we're gonna start to see that they themselves are not going to be passed through. They're going to be viewed as quibs. They're going to be able to invest in these directly, and that's going to how we're going to be able to reach the retail. You know what I mean? Or through things like these stable coin.
A lot of QPs don't come into the market. Just because they can doesn't mean they do. Their advisors don't want them in these highly illiquid asset classes. The burden, the friction to get in, right? The managing capital calls, which will come in like that, and just the mechanism. So a large wealth manager, surveyed, they looked at their high net worth, ultra high net worth, and up to 40% of those clients want exposure, but less than 5% have it. They could move into those funds. They don't, because of the friction and the fund characteristics. Their advisors don't want them there. They're not going there. And so even though, Ken, it is possible, it doesn't mean they're doing it. And this mechanism is going to take away a lot of that friction. It's going to ease the concerns that the advisor has, and it's going to make these investments far more functionally rich and attractive. So the diversification will happen.
Yeah, and Ken, I think you're right about it is a feeder to a single fund, and he can participate in that feeder into a single fund. But we're going to also start to see a whole bunch where feeders give you geographic distribution, but the own fund itself is native, right, to a token. We are seeing that in process right now. One of the things that we see is the traditional providers of these services seek global distribution, right? And we've talked about this before, right? Our chief data scientist says we sell shiny things to dull people and dull things to shiny people, right? The shiny things we sell to dull people are in the alts industry. We're selling global distribution to the mass affluent. To the shiny people, crypto, it's how do you get real assets with real data into a portfolio where you already have global digital distribution, right? And how do you cross that bridge back and forth? And these are the elements. And Ken, I'd love to have a call with you. Thanks for pinging us. Shoot something over to me on LinkedIn. It's been a great conversation. Richard, thank you. I appreciate all the questions and comments that happened back and forth. We love having these. This is the first of 14. Richard's going to be back, I think, helping me co-host a couple of them, where we're inviting a lot of the industry players, and we've had so many of our historical partners and new partners and collaborators jumping in. But Oasis Pro Markets and Pat Lavecchia getting back to me last night, US Bank, Coinbase, all of these guys jumping in. saying, hey, we want to be, I want to be on number 8. I want to be on number 7. I want to be on number 14. And in doing this, so we're bringing also a lot of new players into the conversation with India and GCC. Those are going to be 2 really fun. The Asian Pacific opportunities is going to be a fun one, as is the GCC. So, Richard, any final comments from you, brother? I'm sorry I caught you right as you coughed.
No, Pat, appreciate being able to chat with you. It's always like a rush of insight and ideas because you're so well informed and engaged, in this space. I benefit immensely. Hopefully the audience has as well. There was a link, put into the chat to dry powder. Also, there are several reports we have out. If you search, Bain, tokenization, we're active, in this space, working with clients to help to, create a better future for investors, for financial markets, and for regulators who want, transparency and a safe and sound, financial system. So this is great work. Great stuff, Pat. Thank you.
Hey, thank you all. It's good to be with all of you. I know we didn't answer all the questions. We got a lot. I want to make a final note for the benefit of our legal department. There was no securities advice or financial advice given. We're talking about the state of the infrastructure as we build out and develop this industry. And we want to say, if you want to get into this, make sure that you are talking to your own counsel and the appropriate securities counsel, but also people like Richard at Bain in helping lay out the map and the plan. So it's good to be with all of you. Thanks so much, Richard. You were awesome. Thank you, brother.
Thanks, Pat. Happy Memorial Day, everyone.
Hey, thanks. Same to you.